Financial market or stock market volatility is something that you really cannot do away with. It's something that's going to be part and parcel of your life if you're involved in financial market. So the real answer is, how are you going to deal with it? How are you going to reduce the impact of that on your portfolio? There are two steps that you can take. The first one is to understand sentiment indicators. Sentiment indicators come both in short term and medium term. We've been plotting them for years on our charts, on Excel sheets, and now we've made all of them available to you on the Strike platform. So learning to use them tells you when sentiment is at an extreme on the upside or at an extreme on the downside, where you can actually reduce your risk in the market by reducing your position. So that's a very, very important tool to help you to decide what you really need to be doing and not to be standing out, with the crowd, but away from the crowd. The next thing which is going to be relevant to reducing risk to your trades or your positions in your portfolio is learning how to position size. Position sizing in trade management ensures that you do not really take the entire position at one go. You're going to have to size it up. Whether you're trading the long side or the short side or building an investment case, taking your entire position at one go doesn't always work for you, because sometimes the trade can go wrong. So building a model where you use 5 to 6 tools that are going to be relevant, you don't need more than that, where each one tells you whether you should take a 20% position or a 30% position, allows you to take only that much risk as the market is allowing you to do at this moment in time. Which means that if you have a 30% position when the risk is high, if things go against you, you only lose on that component and don't really lose out on the entire position that you would have taken. And if things start to move in your favor, then you can actually size it up and ride the entire move and gain a lot more from it. So essentially what this does is you're able to, ensure that portfolio risk gets reduced and your returns are enhanced. And that's why it's a very, very important skill set to learn if you want volatility to be on your side of the portfolio.